Hi, welcome to Triple T Trader channel, where my friends and I will share with you the secrets of trading. Today, I will tell you about the top 10 trading terms that a novice should know, and I will give examples of where and how you might use them. In fact, we'll need them everywhere. So let's get started. I think it's needless to explain why a person who starts doing anything new, and I mean anything at all, needs to first learn a couple of basic terms. And if you're still not sure that it'll be of use to you, imagine that you wake up on an island and a wild tribe of aborigines walks out of the forest and comes up to you. Knowing just a couple of phrases like hello and please don't eat me, I come in peace, in their language will probably help you to get through the day. It is the same with trading. If you want to understand what is happening on the market and what other traders talk about, including me in my educational videos, then this information will be extremely useful to you. Spoiler, some things may seem way too obvious to you. However, just don't jump to conclusions. And if you are sure that you know some of the terms well, check yourself. Every time a term appears on the screen, pause the video and try to come up with your own definition first. And after watching the video till the end, write in the comments how many of the terms you knew from the beginning. An asset is a financial instrument that can be traded on financial markets. To put it simply, it is anything that you can sell or buy and make money from it. Shares, commodities, cryptocurrencies, or even contracts for difference. For more information about what types of assets there are and which of them are best for beginners, watch this video by following the link right here. So, there are two ways to make money on the stock exchange. The first is to buy an asset and wait for it to grow in price. It is called a long position because you can hold it indefinitely. Historically, according to one of the market laws, the value of an asset usually grows, and in theory, this can continue infinitely. The second way is to open a short position. The idea is to borrow stock from a broker and sell them on the market at a high price, and then when the price goes down, you buy it back and return it to the broker, putting the difference in your pocket. Just remember that you are to sell and buy the stock you have borrowed, not your own. If you sell your own stock, it is considered closing a long position. Such trading can only be concluded for a short period of time, according to the same market law. Historically, the asset value usually grows. I want to devote a minute to answering your questions in the comments. I guess we should make it sometime on a regular basis. What do you think? Write your opinion in the comments. So the most frequent question under the last video was how to start learning trading. You can start with books that provide an overall picture of the market. For example, Reminiscences of a Stock Operator or The Financier. If you want to get a grasp on charts, you can read books by Steve Nyson, who devoted a significant part of his life to studying Japanese candlesticks. And finally, you can also learn trading from scratch by watching this channel. I hope that here you will find loads of hands-on information and will try to avoid speaking in the set phrases or using a lot of official jargon. Traders who enter deals expecting for the price to grow are called bulls. This animal attacks by tossing its enemy with its horns. And trades expecting a lower price are called bears, because it is believed that a bear attacks by smashing its enemy down to the ground with its heavy paw. By the way, if you want to understand who a trader is, what is the difference between a trader and an investor, and how the financial market generally works, you can watch another video. The link is here. An order is your instruction to the broker to buy or sell an asset. For example, there are market orders and limit orders. We will tell you more about them in the next videos. But now I want to draw your attention to the conditional orders. They include so-called the profit and stop loss orders. You can use a take profit order when you need to close your position and lock in a profit. Then you specify a price that is higher than the current price, and you use a stop-loss order to prevent further losses by closing your position at a certain selling price that is lower than the current price. Roughly speaking, you get leverage when a broker lends you securities. This allows you to enter into transactions that are 5, 10, 20, or even 100 times bigger than the sum on your account. For example, if you have $1,000 and you want to buy shares for 20,000, then you use a leverage of 1 to 20. If your forecast is right and the price rises by, let's say, 5%, then you earn $1,000 instead of 50. That is 20 times more. However, if the forecast is wrong, you lose the whole 1,000. A tick is a standard unit of measuring prices. If, for example, the stock price is published with 2 decimal places, a tick is equal to 1 cent. So, when we hear that some stock is up 10 ticks, it means that the price has increased by 10 cents. A chart is a graphical representation of price changes over a certain period of time called a time frame. The time frame can be 15 seconds, a minute, 30 minutes, 1 day, or even a year. There are quite a lot of types of charts: linear charts, bar charts, but the most popular types is a Japanese candlestick chart. Each candlestick shows the price change between the beginning and the end of the time frame, and depending on whether the price goes up or down, the body of the candlestick is colored green or red respectively. It is the difference between the prices quoted for an immediate sale and an immediate purchase for an asset. For example, if the best purchase price for oil is now $52 and the best selling price is $54, the spread is $2. In other words, it is the fluctuation of prices on the market. High volatility means that the price changes dramatically. Volatility reflects the balance between supply and demand. For example, volatility of 1 to 2% is considered low, which means that trading such asset will be safer and more predictable, but less profitable. A trader will never conclude transactions without thorough analysis. Otherwise, he will be risking his money in a pure game of chance. There are 2 types of analysis. For technical analysis, various tools can be used: indicators, chart patterns, candlesticks, and so on. The main idea of such analysis is to determine the trend of an asset based on its previous behavior. Fundamental analysis implies looking at the economy as a whole in order to figure out the real value of the asset. And if the trader thinks that the price is unreasonably high or low, this may be a good reason to enter into a trade. However, fundamental analysis is effective on monthly or yearly timeframes, while technical analysis can help you even with 1-minute time frame. In any case, analysis is an endless topic, and in fact, that is what traders do most of the time, constantly mastering their skills. We're planning to dig deeper into the subject, and we want to show effective and practical methods of analysis in the future videos. Well, now it's time to draw up the balance. Write in the comments below how many terms you were able to define yourself, and don't forget to subscribe to the channel and leave a like if this video and I were useful to you, and hit the bell. This way you will not miss my next videos. And feel free to ask questions. We will answer the most popular ones next time. This is Story. Goodbye and good luck.